Everything else is same as mutual fund with more complications.
And frankly, it's a play on ego. Rich people are... It is.
So idea is mutual fund everybody is doing, show me something else.
Try, the more entertaining a piece of content on finance is, the less informative it tends to be. So don't run after that.
So as they say, we should try to recognize our biases as much as possible to ensure that they don't wreak havoc with our money. In multi-asset, instead of you and me taking the call about asset allocation, it will be the fund manager.
Correct.
And it will be more tax efficient and operationally efficient also, because 70-80% of the money is being given to subprime issuer who has got typically double B or even C rating.
It's really hard to save these days because social media creates wants that you never thought you had and all this.
उसकी शर्ट मेरी शर्ट से ज़्यादा सफ़ेद क्यों है?
हाँ.
Hello everybody, welcome to another episode of My Money Panda with Wealthy Nivesh. So one of the things that I am very proud about myself is that I am an author with HT Mint, which is one of the biggest business newspapers in India and supposed to be a very strong player in personal finance domain. Today I have got Neil with me. Neil is a editor of personal finance with HT Mint. He's a very senior journalist in the domain and has got around 10 years experience in the industry. So welcome Neil, welcome to the podcast.
Thank you so much for having me.
Yeah, so today we are going to discuss about upcoming asset classes in fund management in India. So Neil, there are two trends which are very visible nowadays. One is SIF and the other is Gift City. So probably we should start with the Gift City because it's a bigger topic. So if you can give us your 50 cents on how Gift City is being developed, what are the kinds of avenues available over there for the investment, and which all people can invest, what are the restrictions, etc. It will be very helpful.
Sure. So Gift City, broadly speaking, is envisaged to be India's Singapore, India's Hong Kong, and
Dubai also.
Or Dubai. And it really helps two categories of people. One is NRIs who want to invest in India without the terrible paperwork around NRO, NRE, PIS, non-PIS, etc. And Indian residents who want to invest around the world, who currently can't do so through mutual funds since RBI limit has been hit.
Okay, so from what I have studied, so there are two kinds of broadly speaking funds. One is inbound, the other is outbound. So inbound means those funds which will invest back into India only, and outbound those funds which will invest outside India.
Correct.
And from what I understand, non-resident Indians, including global citizens. So if I am an Australian, I am not an Indian, I am not an
Correct.
OIC or NRI, I can still invest through Gift City.
Correct.
Into funds which either invest into India or they invest outside India.
Correct.
But if I am a resident Indian, then I can invest only in outbound funds.
That's right.
So do you think that's a big constraint for it to develop into a global center?
No, I don't think so. And the reason is valid, that they want to prevent round tripping. So I don't see a big issue with it. One other thing that people often forget is, apart from LRS, even companies or institutions can invest through Gift City, and they are allowed the OPI route up to 50% of net worth. So a lot of people are investing through that route.
And what about family offices? I was reading somewhere that family offices are getting some complications establishing their office in Gift City.
Yeah, so there was this concept called Family Investment Fund, which unfortunately did not take off. I think the regulator had some second thoughts about it. But perhaps many of them are now doing the standard OPI route. So I think what most people don't realize is that जो LRS का limit है, which is $2.5 lakh, OPI का limit, there is no absolute limit only. Like if your company's net worth is, let's say, $10 lakh, you can remit up to half, so $5 lakh worth through this route.
And that too of net worth, not financial assets.
Correct. So a lot of high net worth individuals would have entities through which they invest, and that allows them really a lot of access to global markets.
But I think there is some restriction that those setups can't invest into properties outside.
Yes, yes. So there are, of course, restrictions on what OPI ultimately can do, but broadly speaking, it's a good avenue.
But what kind of changes you foresee happening into Indian capital markets, if any, because of Gift City?
It can really liberate the Indian investor from just having one country, one currency bias. So, in fact, I'll throw a bit of a quiz question at you. The value of the rupee at independence was around 3.3, 3.4 to the dollar. Um, there was one year in which the rupee had its single largest depreciation. Which year do you think that was?
I think it was during VP Singh's tenure.
No. So it has gone from 3.3 to
86 now, 86,
86
87.
now. A lot of people, and it's a valid argument to think that it happened just before the 91 reforms when India was in serious trouble with
Or
its
it was during
forex.
UPA government.
But no, neither was it then nor was it during UPA government. The answer stretches all the way back to 1966. So after the 65 war, the rupee had a 56% depreciation overnight. And in fact, the date is 6/6/66. The longer term lesson from all this is that you need to diversify, especially if you have kids who are going to study abroad or
Foreign trips.
etc., etc. And thankfully, Gift City is giving an avenue for this.
Great. So I think you made a very beautiful point that it gives you two diversifications. One is geography, the other is currency. And more so when you have you may have end up having expenses in these two in non-rupee avenues. So like you do foreign trips, you do foreign education for kids, etc. But taking into the view that there are very few global funds in Gift City as of now, do you think the focus is more on NRIs or it's a developing story, and in coming years we can have more avenues for resident Indians also?
Yeah. So I think that definitely will take off once the first few retail funds are launched. So far, only AIFs have been launched in Gift City, and they have a minimum investment of $1.5 lakh. That takes out access for most resident Indians.
Huge entry barrier.
Yeah, huge entry barrier. Anyway, above 10 lakh rupees, there is TCS. So that itself is a big psychological barrier. But a lot of the retail funds that may be launched are talking about a $5,000
fund.
ticket size, which is within that 10,000 limit. Or rather the 10 lakh limit for TCS. So I think that would be the trigger for outbound takeoff. Inbound also has not really taken off as much as it could do. And the reasons are, again, AIFs, there are no retail inbound funds yet. And there are those funny complications like Gift City does not have a separate set of SWIFT codes, I think. So money tends to come into India when it's supposed to go into Gift City, and it matters because it's a different jurisdiction. But I think these things will get ironed out. We're all waiting for the first few retail funds on both sides, inbound and outbound.
So I was there in the Gift City around 2 weeks back, and certainly it's a perception. There is no data to back it, and for sure I can suffer for my biases also. But what I felt was that there is a huge vision at place, but as they say, Rome was not built in a day. So do you think, Gift City with the vision, with the backup of the government will come up in coming years very big time?
Yeah, 100%. And I want to add here that even though Gift City right now is a physical location in Gujarat, the way the law has been set up, the regulator is a regulator for financial centers in plural, not a single financial center. So people from other states, you never know. There could be another or a few more such centers that are established.
Great. So you are saying that basis the learning and experience of Gift City, it can be replicated in other places also.
It can be replicated. So we had done an event in Pune, and one of the senior officials from IFSCA had come. So the first question the audience asked is कि आप यहाँ पे क्यों नहीं करते? The answer was हम कर सकते हैं. There's nothing in the law that prohibits us.
So that's a huge political discussion also. Now, moving from Gift City to SIF. So first question, what is SIF? Not only the full form, but also how it works. Second, the objective behind it. And third, how is it developing as a product category?
Yeah, so specialized investment fund, minimum ticket size of 10 lakhs. The idea is roughly that you bring in hedge funds into this category, which is more tax efficient because it's taxed as mutual funds are 12.5% LTCG after 1 year. Provided, of course, gross equity is 65%. But we don't know yet which way the industry will go. Whether they will be daring enough to actually create hedge funds in this category, or will they just do window cleaning and just put a little bit of use some derivatives here and there and just try to asset gather. I don't want that to happen. I hope some real talent, some real good products emerge out of it, because if you think of the essence of a hedge fund or a long short fund, it is to give the investor an alternative to the plain vanilla long only funds that everyone has, the plain mutual funds, which are dependent ultimately on the market. No matter how good your fund manager is, kitna bhi badhiya ho, he's not going to give you positive returns when the market itself is going down. All funds have a beta. But an SIF can actually manage that. If they are truly long short, they can give you returns in all kinds of markets.
So one of the sightings by SEBI in launching SIF was that we want to have something which is between PMS and mutual fund. Now the confusion, from my side is that PMS anyhow invest into long only kind of position only. So they can take 5-10% derivatives also. But SIF is more into, derivatives, as you said, hedge funds, etc., fancier option. So do you think that way it's a wrong positioning? So if I position it something between mutual fund and PMS, and then I say ki it will have 10 lakh rupees ticket size, but the underlying is even more fancier and riskier than the PMS. So do you think in that sense this positioning doesn't hold good?
Yeah. So actually we had broken the news on SIF that it's going to come out. And that time we were told by our sources that this was the positioning. So it kind of went into industry consciousness that this is how it's going to be. But I think over time, they had a committee and I think over time, it crystallized much more into a AIF replacement than a PMS replacement. So I completely agree. It's not. In fact, SIFs are subject to the same exposure limits to single stocks, the 10% wala limit that a mutual fund is. So it's not a PMS competitor, it's an AIF competitor, and particularly Cat 3 AIF competitor, because Cat 3 AIFs are tax wise messed up. When you have a 39% tax reduction at source, your end investor is not really getting much. If that moves to a 12.5%, then clearly we have a migration case.
But how do you look PMS holding up in this situation? So I'm giving my client option that you can invest 10 lakh rupees into fancier option, and then I say you have to invest at least 50 lakhs in PMS.
So I always felt that on the surface the allure of PMS is concentrated bets that you can have. Instead of max 10% exposure, you can have some stock which is 20% of or more of the portfolio. I've honestly never believed in PMS as a product because I think that it is tax inefficient, it is high cost, and it usually leads to grief in many ways. Mutual funds do everything that PMS can and more. Of course, some PMSs tend to outperform in bull markets, but that's an upside worth giving up.
So my understanding is that except for slight customization, so like in PMS you can give so client can say I don't want this sector or I don't want this company. Everything else is same as mutual fund with more complications and higher ticket size.
Yeah.
And less liquidity also.
And frankly, it's a play on ego. Rich people are It is.
So idea is mutual fund. Everybody is doing. Show me something else.
Exactly.
So it's like even a driver is doing a mutual fund. So show me.
Exactly.
As they say, all dikhao, all dikhao.
Absolutely.
That's that kind of. So that was the objective that we discussed about SIF. My feeling.
There are a couple of SIF categories that I want to add that could come up. So one is credit risk. Now, after the Franklin debacle, credit risk has gone out of the mutual fund industry completely, to an extent that investors are not getting the full range of returns or products. So there's been an overreaction almost after that whole episode. Now, credit risk, if it comes through the SIF route, I think is a good thing, because SIF is higher ticket size product. Selling it is also not as easy as a retail mutual fund. So that option will come back on the table. Right now, people who want to take credit risk are being sold bonds, direct bonds, which are even more risky. So
concentration risk.
Yeah. So I'm hopeful this comes back through the SIF route, obviously with all kinds of safeguards in place. The other product that can potentially come back through SIF route is the MLD, or structured product. So this was commonly sold to investors before the, I think, 23 budget, which plugged the tax arbitrage on it. And essentially what a structured product does is offers to return your capital back at the very minimum, and some participation in upside if the market rallies. And there's a capping, because they use calls, they use derivatives to achieve that objective. So you have to give up some upside, but your downside is protected. So if they can reconstruct that through the SIF route, then why not?
So I did analyze MLDs, and the problem is ki devil always lies in fine print. So what they do, they have got three kinds of asset classes underlying. One is they have long duration derivatives, which they claim that only institutes can access, individuals can't access. The second is they give debt to their in-house companies, in-house subsidiaries. So a subsidiary which otherwise would be getting debt at 18% will end up getting 12% only. And third is of course equity also. So what people don't realize, when you look at it as a black box, that whatever is inside you don't care, you just care for what is in store for you. It sounds very good. The typical pitch is ki market goes down by 20%, you go up by 5%, market goes up by 10%, you go up by 15%. But we realized ki this kind of offering is not worth the underlying risk, because 70-80% of the money is being given to subprime issuer who has got typically double B or even C rating. Money is given even to ARC companies, where ideally there can't be any rating, because it's a very uncertain business. But coming to initial discussion about SIF.
No, but let me just add on that point. So if this product comes back through SIF, it will not be dependent on the credit rating of a single issuer, which was the case in the old avatar. I presume that in this case they will have a diversified debt portfolio to give that steady debt return, and the equity part they'll do derivatives.
Yeah, so I think in credit risk category it will work very wonderfully, because what you said now, it made me realize that probably right now a credit risk debt fund gets lost as another debt fund, and people are not comfortable selling it because it's a very risky product, and from investor side they feel that it's a debt fund.
Yeah, it's so ironic, because they're not taking credit risk anymore.
Yes. And when it comes through SIF, probably because SIF inherently is being marketed as a riskier product, so people will have this idea that this is a risky asset class. But for MLDs, I think if they carry on the same imperfection of current MLDs, that 70-80% of your money is going to a subsidiary company only, which has got a subprime kind of rating, then it may not be a good idea. Now, so we have discussed about objective behind SIF. Do you think SIF can be, and certainly it has not been said by SEBI. Let me start with a disclaimer. There is no official quote on the same. This is my understanding. This is my hunch. This may be one of the objectives. So there have been a lot of talk about high volumes of derivatives in India. You know, all kind of people doing derivatives on a daily basis, investing their time 9 to 3:30 in this kind of work. Do you think SEBI thinks that this way those people will get access to this kind of asset category, which is being managed by a professional team instead of they doing it themselves?
Yeah, I had not thought of it that way, but you're right.
So that way, it may help to wean away some people from those kind of investment philosophy.
Yeah, a very small fraction, unfortunately, because the vast majority of them are hooked on to F&O, and no amount of losses seem to convince them to stop trading.
So that reminds me a very spiritual story. So when Pandavas were invited by Kauravas for gambling, so what they did na day before they ensured that Yudhishthira wins the game to make him very confident. So next day they invited them for a bigger game, and Krishna was telling Yudhishthira this you should not go for this, and Yudhishthira was saying ki, you know, I'm a perfect player in this game.
मैं तो जीत चुका हूँ.
मैं तो जीत चुका हूँ. And Krishna said that in this game na it's not about the player, it's about the dice which decides the outcome. And probably it's the same story being played in this segment also, that people are getting addicted to it. It's a typical addiction. In fact, there is a recent story where this guy was losing money in online gambling, and he became so addicted he lost lots of money, and he ended up being on the payroll of ISI while working for Indian Navy. So those are probably are the temptation parts which brings out the worst in us. So we discussed about the objective of SIF. We discussed about how they will be positioned. If you can just share which all AMCs are bringing SIF as of now, when are others supposed to come with their products, and what is market reading about the product?
As far as I remember, 2 AMCs have got the in-principle approval to launch SIFs, Edelweiss and Mirai, and they have created separate brands for this purpose because that's required by SEBI.
And they have launched brands also.
They have launched brands, yeah. But specifically, no funds are yet live.
Okay. And I believe in next 2-3 months, they will start launching the funds also.
They should, yeah. Right now, there's a talent war happening, right? Who is going to manage?
Yeah. So I got to listen very interesting stories about the same, but probably that's for some other day. So, coming to personal finance, where do you invest your money? Or let's say, how do you invest your money? Or if you can just take us through your journey about investments. I believe you are in your 30s.
Mid-30s.
Mid-30s. So if you can tell me about your journey in your 20s and 30s, about how your portfolio management developed. And before that, a very intriguing question from my side. I believe you are a lawyer by training. So what made you come to personal finance side?
Yeah, I always tell myself if I had stuck to law, I would be earning multiple times what I currently make. But I had a somewhat...
Eureka moment.
Yeah, eureka moment or this curiosity which just had to be fulfilled about how economy worked, about how markets worked. And that time my parents, my dad was sort of questioning me a lot on these things, trying to get me to think about investing. So they are doctors and they had some money to invest and so he thought ki beta hai usko thoda kaam karwate usse. And so it sort of put me down in a rabbit hole. And I thought before I tell him how to invest, I should study the subject. So I did a second degree in economics and I did my CFA level 1 also. Then I briefly worked for a SEBI registered investment advisor. And initially that was actually my plan. My career was going to be as an advisor. But the pay was not supporting it. So when there was a chance to join Value Research as an associate editor, I did. And since then, I've been writing about this for the past 9 years. Now, about how I invest. So, I've had a very typical journey in the sense people tend to make their mistakes in their 20s. I certainly did. I did F&O before F&O became a thing. and I lost money there. The other big mistake that I've made a lot, unfortunately, and I keep repeating it, is I tend to pull out of things too early. Uh, so this comes from personality. I have a somewhat skeptical, cynical personality, and so when there used to be negative news about things, I would redeem my equity investments too early, and it's only in the past few years that I've learned discipline. Despite being in this profession, despite studying all of this, uh, it took me a long time to.
So I have one interjection over here. So the first time I read about confirmation bias, that was eureka moment for me. I was like, I have been doing it all the times. So most of the times we are either not aware of our biases or we don't, act upon them. In the sense ki means we subconsciously keep on acting upon them in spite of having those biases, instead of even recognizing that we have those biases. So you said that you started with FNO, so that made you learn what not to do with your money.
Yeah.
And then right now you're investing through mutual funds or direct equities. You have any framework in place? You have any asset allocation, goal planning, anything?
Sure. So it's 99% mutual funds or ETFs. A large chunk of before I get to the fund types, in terms of asset allocation, I hover around the 50-50 mark. So sometimes I'll be 60-40, sometimes I'll be 40-60 the other way.
Between equity and debt?
Between equity and debt. And within debt, I'm also including gold, because I've always been a gold bull. Within
Typical Indian.
Typical Indian, yes. But what I want to emphasize is I have never been so bullish on equity as to go 100%. I know people who do that, and we have interviewed people who do that. But I can't take my equity psychologically beyond a 60% mark. Even at a young age, like some people say if you're young you should do it, but I haven't done it. So I'm currently roughly at that 50-50 mark. Within the 50 debt portion, I'm including around 10% gold. I was more into gold. I at one point reached 20%. I took some profits in April and May. So that has come down. I will never take it below 10 because I am one of those perennial gold bulls.
But that would have worked for you very well in last 1 year, no?
Yeah. It's one of the few successes I've had.
So that reminds me of the fact that in multi-asset category, ICC multi-asset was the fund which was having 20-23% gold in last 1 year. So its return has been phenomenal.
Yeah, I agree.
Yeah. So to continue your part only, you are saying you have 10% in gold typically, then 30-40% in debt, and then rest in equity. That's the asset allocation.
Correct.
And this will be across mutual funds and ETF mostly.
Correct. And I have multiple products as well. So I don't just do mutual funds. There's also NPS. There's also PPF. In case of EPF, there's no choice. I have that. So it's different things.
And how do you decide which scheme to invest into? Certainly, I can't ask you which schemes you invest into because of profession. But how do you decide? So let's say, I'm just assuming you would be having a top-down approach. You first decide 60% in equity, 30% in debt, and 10% in gold. Then in 30% you will have this much in PPF, this much in, let's say, credit risk fund. And equity side you will, let's say, decide that I'll have 40% in large cap, 30% in mid cap, or 30% in small cap, whatever be it. So after that, you will be deciding schemes only, correct? So do you have any specific number of schemes in each category? First, so let's take it this way. How many categories do you have in mutual funds? Do you have any principle that you will have these many schemes in each category? And then finally, how do you decide those schemes?
Yeah. So I try to be a minimalist. I believe quite strongly that as you go beyond 5 schemes, you lose track and you end up replicating the entire market. So it's not helpful.
So for us, that number is 6. Very much near.
Yeah. So in the equity side of my portfolio, in terms of active funds, I have just 2. One flexi-cap fund, and here I have a strong belief that instead of dividing one's portfolio into large, mid, small, then yourself rebalancing and incurring taxes, one should pick a flexi-cap fund and leave it to the fund manager to do it. And the one that I pick also has global exposure, and follows what I call this.
I think by now everybody who have recognized what it is.
But I'm not going to say that. I'm not going to say the name.
So that
here.
is one active one, and other one.
The other one is a more recent pick. It's actually a multi-asset fund. I'm putting it in the equity bucket because it has, if I remember correctly, more than 60% gross equity.
And I think it makes sense to have multi-asset in equity because by mandate they can go up to 80-90%,
Yeah.
80% up to 80% into equity.
Yeah, correct. It's a very fascinating fund. It's a multi-asset fund of funds of passive funds. Like it has a bunch of ETFs in it, some of which are global ETFs also. So those two are on my equity as active side. I do have passive, so I have a plain old Nifty ETF. When I switched out of gold, I moved to Nifty ETF.
So you mentioned three principles. One is ki you have lesser number of funds, on which we almost agree. The second is ki you have multi-asset approach also. For that also we agree, more so in these volatile markets. So the reason that we tell our clients is ki in multi-asset, instead of you and me taking the call about asset allocation, it will be the fund manager.
Correct.
And it will be more tax efficient and operationally efficient also.
Agreed.
The third one on which we sought to disagree is flexi cap, and I'll tell you in this domain there is nothing like right or wrong. It's all our approaches. Our thought process is one, same fund manager can't manage all three asset classes, small, mid, and large cap. The second reason is ki we believe ki I totally agree to your point ki we should give it to the fund manager to manage how much should be relative allocation. But what we have realized ki the benchmark is Nifty 500, which has got 70% in large cap. So there are very few fund managers who are ready to take that kind of allocation call. Most of them are like ki 70% large cap mein, so I should replicate that kind of asset allocation only. So that's the reason because of which we don't do it. But as I said, everybody has got their own ways of doing it. So mutual funds, ETF, PPF, debt fund. And you said that you sometimes tend to take it out before it should be done.
Yeah.
Do you think there is any other thing that people in 30 should be aware of?
Yeah, stay away from the noise. Stay away from the social media noise, from the mainstream media noise. It's not helpful. You don't want these guys on TV every day dishing out calls like they're samosas. They're never going to create wealth for you.
So I can't help discussing this topic with a journalist, with a personal finance journalist. In fact, I had another podcast with Kaizad, who is a senior journalist from personal finance only. And we discussed this thing only. So on one side, there are people like, let's not say people, let's say on one side, there are sources which are boring, which are backed by research, which are not very exciting, which are very theoretical, and which are very academic, and which are time tested. On other side, you have got sources which are very sensational, which have got background music in their delivery, which make claims like this crypto will do good or this stock will do good. And more often than not, and most of all the vast majority, they end up, following the second one. Like I'll tell you my own story. Even though I've been in this industry, I've been a wealth manager for last 12 years now. But still there will be things which I will learn reading HT Mint, which I will be learning reading ET Wealth, which I won't know per se. Or I won't recognize them that way. And then there are people who are investing for the first time and they feel that, they will get the best of money management tips on YouTube or tips they will get. So do you think that's a bad manifestation of community level greed?
Yeah.
Or it's a passing phenomena?
Passing or not, I don't know. In fact, in some ways it's gotten worse because now AI has entered the picture and AI can mass produce that kind of content at scale at very low cost.
Ego.
Yeah. There's no other way out of it than for people like you, people like me to, put forward the right message And the other option is you pay your dues to the market. You follow the tipsters, you lose money and you realize, oh shit.
So that was the answer given by I forgot the name of the partner of Warren Buffett.
Charlie Munger.
Charlie Munger. So somebody asked Charlie Munger, should we do trading? And he said that certainly you should do it. And then he was like, why don't you do it then? And he replied back, if people like you don't lose money in the market, how will people like us make money? So he was supposed to be loudmouth, loose cannon when it comes to, saying things. And probably that defines it. I draw an analogy with mainstream news channels. So, there used to be a time when news, even the TV news used to be very boring, with very boring introduction music only. There was no background music. And now we have, kind of news channels which are more of animation channel, which are more of reality shows. So, do you think it's too much optimistic to think that people will realize that this is better way of making money as compared to this sensational one?
I think most people do realize it as they get older and as they burn their hands. There's no other way out of it.
But
if you had told me in my 20s, don't do F&O, I would have been like, what the hell is this?
But, as a wealth manager, I have seen a very bad manifestation of it, in the sense people then become indecisive. So when they burn fingers, so like you took a call ki F&O was bad, but then mutual fund sahi hai. But many times people are like ki market hi kharab hai.
Overreaction ho jata hai.
Or I am not made for the markets. So that probably is how things work with the crowd or community kind of level. But so coming back to personal finance only. So for estimate only, I wrote an article where I mentioned about two questions that help you to manage your money. One is how much you can invest. Simple equation, income minus expenses. And second is how much you should invest. That is about goal planning. A very good friend of mine made this point to me कि we always think about maximizing investments, but there can be times when we are compromising on our lifestyle for the kind of for the level of savings or investment which won't serve their purpose in our lifetime. So that's another equation that we misses. So but coming back to these two questions of how much you can invest and how much you should invest, do you think more often than not it's very simple things that we miss when it comes to personal finance? And as you said, ignore the noise and we get lost in the noise.
Oh, absolutely.
And how do you think this can be countered?
So in fact, you pointed to one thing which was probably not as big a problem 5 or 10 years ago, which is rampant consumerism. And it's really hard to save these days because social media creates wants that you never thought you had, and you end up and I struggle to save despite knowing all this.
उसकी शर्ट मेरी शर्ट से ज़्यादा सफ़ेद क्यों है?
हाँ.
वो लोग दुबई गए हैं, एम्स्टरडेम गए हैं, मैं क्यों नहीं गया?
Exactly. Or it could just be as something as simple as having that 300 rupee coffee instead of having the 30 rupee one. So the way out of it is hopefully that enough of us spread the right message and people learn. I mean, through their mistakes or other people's mistakes, but they learn.
Correct. And any advice that you would like to share with our audience? Let's say 3 advices. Why 1? You are a journalist, you should have more content.
So I would say try to learn as much as you can from other people's mistakes, not your own.
Not only yours.
That's the hard way to, your own mistakes are the hard way to learn. Second is try, the more entertaining a piece of content on finance is, the less informative it tends to be. So don't run after that.
Good one. And third one?
Keep it simple. You don't need products that pander to the ego like we discussed earlier. Fancy stuff. A portfolio of few mutual funds will actually achieve most of your goals.
So that reminds me of a very good discussion that I had with a fellow startup founder, and who has been funded by very big names. Of course, I won't name either the startup founder or all the people who funded him. And I asked him, so he's a good cousin, he's a family cousin, so I always address him as Bhaiya. And I asked him, ki Bhaiya, uh, from whatever public domain knowledge I have got, the typical post expenses, post taxation returns of VC fund varies from 15 to 20%. Some very good one are only able to generate 20-25% return. With the blocking of your money, with more uncertain returns, and if you compare it with, let's say, small cap mutual funds in India, the typical return is 20 to 25% with complete liquidity, with no uncertainty, because volatility compared to VC as a business is lesser. So, do you think what I said is correct? And he said, yes, it's correct. And we both agreed that it's this reason only which you only mentioned, that it's about pandering to the fact that I can't invest into mutual funds because it's a very retail kind of product.
Yeah.
Another instance was when I talked to a PE equity fund manager and he was telling me that we are giving a guidance of 21 to 22% return. Post expenses, post tax, it will come out to be 14-15%. And I asked him, tell me one thing, without giving you 1 crore, by investing as low as 10,000 rupees per month, I'm pretty assured, I'm not using the word guaranteed, but I'm pretty assured there will be at least 5-10 small cap mutual funds which will give me more than 20%, for sure. Then why should I invest in your product? And I didn't get any proper answer from him. His only idea was that you can look at it more as an asset allocation. So, as you rightly said, more often than not, our personal biases, so this is also one of the bias, this is not good for me because it is good for somebody who's earning 50-60,000. I have got more money, so I should invest into fancier options. So as they say, we should try to recognize our biases as much as possible to ensure that they don't wreak havoc with our money.
No, absolutely.
Great. So great talking to you, Neil. I really loved the free flow discussion that we had, and certainly, even though I am not a journalist, but being a very responsible wealth manager, I believe I am a very responsible wealth manager. I do pray to God that people do recognize which are the better sources of learning about personal finance, and they also realize that it's not as difficult as it sounds to be. And third one, I believe that they should at least make a start.
Thank you so much. Thanks for having me.
And thanks for bringing all the knowledge for through your medium, etc. Love reading your stuff. Thank you. So if you have got any specific topic in mind which you want to discuss, or for us to discuss, or which you want us to create content on, do mention it in the comment section, and we'll try to produce content on the same. Thanks for being good audience, and thanks for joining us today. Thank you.